Well, this week we're reviewing the Analytics Moderate Fund of Fund. Now, the manager of this fund, Lance Vogel, the benchmark CPI rolling 3 to 5 years, fund size 589 million rand. It was launched in July 2001 and the TER sitting at 1.67%. Firstly, because it's a fund of fund, let's break it down and take a look at the underlying funds that they own.
Yeah, I mean, I think that's the important differentiator here. Often we look just at kind of normal equity funds or bond funds or balance funds. This is a fund of funds. So it's a fund that holds a whole range of funds. And there's two ways that you could basically become a fund of funds. The first one is that you actually hold other CISCA regulated unit trusts. That means those are listed and you could actually buy those on your own as well as an individual in the street. The other way is to actually have what is called CISCA regulated, but your own unit trust, where you basically hand out different mandates. It's often something that multi-managers do. In this case, though, if you just look at the screen, you'll see what the different managers are that are within the Analytics Moderate Fund of Funds. And you'll see there right at the top, there's the Analytics Managed Equity Fund. That's obviously is a fund that they manage themselves. And then you see Investec Diversified Income that they outsource, Old Mutual SA Quoted Property, and you can see some of the other ones there as well. Investec Global Strategic Managed obviously is obviously part of their global exposure. So over here, you're trying to look at the skill in order to actually choose other managers, plus obviously your own skill as well.
Roland, at first glance, what are your thoughts in terms of the underlying holdings?
Look, these are obviously well-known unit trust companies, so they've gone with the established players rather than the new up-and-coming kind of players. The challenge with a fund of funds is always, how do you, if you're not happy with a fund manager, change that? In other words, you have to hire and fire managers, and that can't happen very quickly and very efficiently necessarily. So they have to pick this carefully. What control do
fund of funds have over the managers of underlying assets?
Well, they set obviously certain mandates and also make sure that the fund managers stay within the risk limits or within the asset allocation that they require at fund level. But if you are unhappy with a fund manager, you're going to have to at some point let go of that manager and replace him with another manager, and that just takes cost and time. So you've got to be very careful because you're going to be stuck with this manager for a while.
Yeah, that's why, I mean, when you choose managers, make sure that you choose managers over 5-year cycles. You know, people that buy managers and then sell them within 6 months, they've made the wrong choice in the beginning. You know, often you make a decision and you've got to give a manager the opportunity to go through a full cycle, however long that might be. And you know, often you get a feeling for how a manager actually operates and what a skill level looks like in both up and down markets. Let's just maybe look at some returns quickly for this fund, just to kind of give you a full picture. And there you can see the fund returns relative to its benchmark, which is CPI. I mean, this is a moderate fund, 40% allocation basically to equities. And you can see what that, I mean, literally 5 years, Roland there, 6.3 versus 6.2. What do you think the benchmark here? I mean, CPI as a benchmark for a moderate fund?
I'm not, I mean, most funds have a CPI plus kind of mandate. So this is less usual to just have a CPI. It's actually, you can get CPI returns by buying inflation-linked bonds. So I'm not necessarily a big fan of this benchmark. And if you look at their fact sheet, they actually say that their equity allocation remains between 40 and 65%. I would think a more appropriate benchmark would be the midpoint of the equity range that they're going to be holding. So that would be around 52% in equity. So any benchmark with 52% in equity should be a more fair and relevant way to compare if they're adding value.
I mean, if you just had to look at the asset allocation, that really underscores the exposure to equities, because they've got 40.3%.
Well, they're underweight equities.
In South African equities right now, and then they've got 17.5% in foreign equities.
Correct.
So 2/3 of the portfolio.
Yes, but they underweight their sort of long-term equity allocation, so it's actually they're quite conservative in that regard. The interesting things is things like they've got 7% in foreign bonds. Now, foreign bonds, if they're government bonds, aren't exactly the most exciting asset class to be in, but maybe it's more of a currency play, or maybe they're into some kind of corporate credit globally. But we've got 22% in domestic bonds, so it is definitely a moderate, conservative kind of exposure that they have.
Yeah, I mean, you know, CPI is a benchmark again. You know, that's why a lot of guys in the industry, they go and they say, look, we want to make it absolute because we want to try and do something for the planning industry. So we're going to give you a CPI-based benchmark, but then, you know, we're going to have another benchmark, which is a market-related benchmark as well, where you could ascertain skill and you can able to have a look at the fund relative to this, skill level. Let's just quickly look at what the skill level looks like in this fund. This is now the rolling 12-month returns for the fund, and you can see that in the blue shaded areas. Those are rolling 12-month returns relative to its benchmark. And you can see there's, in some cases there is underperformance relative to this benchmark. Other cases there's obviously great outperformance relative to this benchmark. So I mean, it certainly shows deviance around the benchmark, so to speak, which basically shows that they're trying to achieve something around CPI.
If you just look at the commentary around the fund, they're very much focusing on all the uncertainty in the global environment. They talked about, quantitative easing 3. This was before we knew whether it was going to happen. They talk about what's taking place in Europe, the ongoing crisis there, uncertainties around the slowdown in China. So, of course, key macro themes that are really driving the uncertainty. And they're basically saying that this fund is best positioned to be able to deliver returns in light of all this. Would you agree with that, Roland?
Yeah, I think they're absolutely in that position. I think they are not that positioned to quickly adapt if the markets start running. And generally when the good news comes, it's going to come quickly and markets run. They only have 3% in cash. So it's very hard to get back into the market if you don't have enough cash. We've often seen funds on the show that have had a very high cash and a very high equity allocation, which is sort of a smarter way to maybe allow you to be more adaptive to changing market conditions.
I mean, this moderate conservative, I don't know if you'll agree with me, moderate conservative, that whole space at the moment must be very tough to manage. I mean, you can't go overweight equities because the valuations just, they're not there.
Don't warrant it, basically.
Yeah, not warrant it. Property is a tough asset class to swallow at this stage, regardless that the yields look fairly attractive in that space. And then you've got bonds and cash. Now, I mean, you're buying bonds, globally, you're buying those on multi-decade lows. And I mean, South Africa, that's no exception either. So, and then you're trying to target a return, and you're trying to give positive returns, in this case, over 3 to 5 years, and many moderate funds are trying to do so over 5 years. And if you run a high equity mandate, then quite frankly, if you achieve returns, if you've got downside in the short term, well, that's okay. You're going to recover. But a moderate fund over 5 years at this stage, where do you find the instruments? I mean, it's pretty tough, Roland.
Yeah, I think the best way to run these kind of funds is actually to look at volatility levels. In other words, you target a certain level of volatility and manage around that. I don't think a strategic asset allocation, which determines how aggressive you are, is that useful because of exactly what you said, is you can be stuck in these asset classes because that classifies you as moderate or aggressive or whatever it is. But actually what you really want is a level of volatility that is not explicit from an asset allocation necessarily.
Well, a lot to think about. Thanks so much for joining us. That's all we have.